Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you have joined us for our 3-day Metals and Mining Conference. Our next presentation is from Ecora Resources. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for a one-on-one meeting by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Jeff Callow, Head of Investor Relations at Ecora Resources, which trades on the OTCQX Best Market under the symbol ECRAF and on the TSX under the symbol ECOR. Welcome, Jeff.
Thank you, Greg. I'll say good afternoon, as I'm based over in London, but good morning to all of you who are viewing over there in North America. Thank you for taking the time out of your schedules to come and listen to this presentation about Ecora Resources. I'll keep it at a relatively high level given the time constraints to allow time for questions, but I'm very happy to take any follow-ups that people might have after the conference if they want to get hold of me, which they can do either through OTC or you'll find my details on our website. The usual legal disclaimer, which I'll gloss over, but if we get into Ecora, an overview of the business, we are effectively, and some of the things I'd like you to take away really from this conversation that we'll have in the next 20 minutes or so. We're a royalty company, and you'll be familiar much more so actually than European investors with the royalty model. So what we try and do is, if I was to give you sort of 3 or 4 takeaways, we're taking that basic royalty model, but we're applying it to a slightly different commodity basket. We do not do precious, so we don't do any gold or silver. We have a very limited part of gold, but we won't be adding any more really. Our focus is on critical minerals, which we think are very much exposed to sort of global megatrends, if you like, such as electrification, power storage, digital infrastructure, AI, data centers, all the things, urbanization, I think all the things that you'll be very familiar with. So that's a bit of a point of differentiation for us. It's taking that model and applying it to a very different commodity basket. And we sit here today at a point where our revenue is looking at a real period of growth. We expect, as you can see on that chart, around 70% revenue growth from 25 through to 2030. And interesting, the base metals part of our business will see even greater growth. So that will go from about $20 million last year to making up around $100 million next year. So sort of about 400% growth in that base metals part of our income generation as we transition and we see a coal royalty rolling off. So a real interesting time to be looking at Ecora, I think, as we go through this period of significant growth. The quality of our mines, I think, is really strong. We've got some really good partners, and we'll look at those as we go through the presentation. And we are producing a reasonable amount of revenue. Last year, we did over $60 million of portfolio contribution, and the current consensus for the sell side is about $60 million again this year. So we're not one of these small companies without any production and lots of longer life, longer dated assets, but we do have that growth coming through. And we do pay a dividend of around 25 to 35% of free cash flow. The final point I'll make before diving into the presentation, and I'm sure lots of people will say this, but we do trade at a big discount to our NAV at the moment. And so we think it's actually a very good time to be buying the stock, a good entry point. And to that extent, our Chief Executive and Finance Director and other directors, in fact, have all been buying in the market recently and consistently over the last 12 to 18 months when they're allowed to, and we're out of closed periods. So the executive are very much buying the stock and have been putting their money where their mouth is, as we say over here. I won't dwell too much on the next slide because most of you, I assume, in North America will understand the royalty model. As I say, we're applying it to critical minerals. For those that don't, a very quick introduction to it. Effectively, it's we'd say lower risk than a direct investment into a mining company. What we're doing is we're generally providing capital to a mine for whatever purposes it might need it. If we're providing, for example, 20 to 50 million, then it could be bigger than that, could be smaller, but let's say it's 20 million. We'd get a royalty, which then entitles us to a percentage of the revenue generated by the production of minerals from that mine for the life of the mine. So our royalty income comes very much from a percentage of the revenue from the mine, and therefore it's before all the operating and capital costs. So at a time of commodity price inflation, we tend to benefit and our margin expands, whereas the operator's margins can come under pressure for the cost inflation coming through. And the real upside exposure for us, part of it is about timing the entry correctly to give ourselves the most leverage to price, but also it's about picking mines that we feel have the ability to have life of mine extension, exploration activity, and then entering at a commodity price where there can be outperformance. That generates the outsized returns for us. A quick portfolio snapshot. Looking at our portfolio today, we are around 80% base metals, around 50% of that being copper. And our coal is actually less than 5% of our NAV, even though last year it was about 60% of our income, and and in 2025 it's probably about 40% of our income. So we're at a point where we have a long-dated coal asset which is rolling off and will be done pretty much by next year. And the future is really all these base metals and specialty metals coming through and driving the growth over the next few years. And I'll show you a slide in a little while which brings that together for you. But just to give you the context for our business, we're really at this transition where we're redeploying those met coal cash flows in the last couple of years of that asset, and have been over the last few years, into building this portfolio. And what we'll see over the next 5 years is really that asset base that we've built starting to become income generating and really drive significant income growth. When we're buying new assets and investing into new royalties, some things we're very keen on. One is making sure we're very low on the cost curve when buying that mine, so you can see, or buying that royalty or stream. So you can see that the mines we have exposure to are about 80% of them are in the first or second quartile, so very optimally positioned at the lower end of the cost curve, which is really important in times of downturns in the commodity price cycle. And we need to make sure that our mines that we're exposed to can continue to generate income. These are 20-year investments, so we want to make sure they can continue to generate income across that period and aren't shut in for any period. So cost curve positioning is really important for that. We don't take a huge amount of geographic risk. You can see that bottom left there. About 85% of the portfolio is OECD, and we include Brazil as an established mining jurisdiction. So we don't take a huge amount of risk there. And we think that's important. As a royalty company, we think the whole offer for us to investors is very much a de-risked way of playing the mining space. Therefore, we try not to offer huge amounts of risk through things like that. And the stage of development, if I'd shown you this 10 years ago, this chart on the bottom right, it would have looked very much about 85% would be producing. That would be principally one asset, this met coal asset called Kestrel. So we've really worked hard over the last 10 years to redeploy that, build up a much more diversified portfolio with around 10 producing assets now, which makes about 55% of the value, 40% in development, and about 6% early stage. Broadly speaking, we're quite happy with the way that's at that allocation of value. The challenge for us now is to deepen that and provide more diversity, and that's something we're focused on the whole time. And I talked about our operating partners. There'll be some names here which are very familiar to you as a North American audience, like Vale and Capstone and Cameco. So we think we've got some great exposure, next gen, to some really good quality operators there in charge of our mine. So while we're a small company in terms of our market cap, the operational exposure is not that you normally see commensurate with a company of our market cap. It's exposure to much higher quality, larger operating assets. I'll run through the portfolio very quickly and give you an overview. I won't go into it given time and lots of detail. This is our base metals portfolio. The three key assets, and I will touch on these in a few moments in a bit more detail, are Voisey's Bay, Mantos Blancos, and Mimbula, which you can see on the left-hand side. They are a cobalt stream at Voisey's Bay, coming off from that's obviously a nickel mine, as many of you will know. That's transitioning at the moment from the open pit to the underground. The underground mine expansion was completed last year. And what that's doing is driving some near-term growth for us as the volumes from that start to increase throughout 2025 and into 2026. So we'll see near-term growth from that. We see near-term growth from Mantos Blancos, Capstone's copper mine in Chile, where there's been some optimization to the mine last year and some debottlenecking, which has unlocked some improved operating performance. So we're seeing production in 2025 up on 2024, and there's some more things they can do there to unlock further growth in the coming years. I mean, Mimbula is an asset we acquired earlier this year, so it's we won't get a full year contribution from this year, but it did about 15,000 tons per annum last year. It's Moxico is a very well-regarded private company. It's based in Zambia. They did 15,000 tons per annum last year. And we're expecting to see this brownfield expansion that's currently underway take that mine up to about 56,000 tons in 2026. So some real growth coming through from those key assets there that are all in production today and all fully paid for. There's nothing in this portfolio today that you'll see that we have any further capital commitments towards. The two projects on the development side I'll draw your attention to here will be Santo Domingo and West Musgrave. The Santo Domingo is a Capstone development in Chile. They recently completed, about 18 months ago, a project called Monteverde, which is only around 30 kilometers from Santo Domingo. So with Monteverde ramping up, once that's completed, they'll be looking to switch to Santo Domingo. There's a lot of work going on at the moment on the engineering side for that project. They're out searching for financing partners. If you're interested in more detail, Capstone gave a very detailed update on that with their results last week. Effectively, they are looking to get that into a position for potential FID from the middle of next year. So from us, probably a couple of years on from that in terms of waiting for income. But that's a very big project for us. At current copper prices, we'd expect to see around $30 million a year to Ecora from that one. So that's a really, really big project for us. West Musgrave is a copper nickel development in Australia. Was operated by Oz Minerals, moved to BHP. That one's been held up a little bit. It's about 25% constructed, but construction was paused due to the fall in the nickel prices last year. BHP suspended its Australian nickel operations, and they'll look to review that decision in February 2027. I think they're expecting nickel prices to come back towards the end of the decade, and will hopefully start to restart construction with a view to timing the start of that project to bring those units into a more buoyant nickel market. So it's a very good project, very low on the cost curve. 40% copper, 45% copper, 55% nickel. So that's about $15 to $20 million at current prices. So again, a very big one. We expect that to come through. It's just probably been delayed by 18 to 24 months compared to where we initially expected it. Some other development projects there. Piauí is an interesting one. That's nickel coming from Brazil. Brazilian nickel's out financing that at the moment. And then the longer dated ones in here, Viscachitas and Camargo, quite interesting, but they're not till the 2030s, so I won't dwell on those now. Specialty metals and uranium, principally uranium here. McLean Lake Mill is where the ore from the Cameco, the uranium from the Cameco Cigar Lake mine goes for processing. So we have a toll milling arrangement there where we take a percentage of the toll milling fees. Uranium from 4 Mile in Australia, vanadium from Maracas Mention, which is a Largos mine in Brazil. But potentially interesting, there are a couple of developments here which are more significant perhaps than some of those production assets. Palabora, one we came into last year, is rare earths. Rare earths is it's probably the lowest cost rare earths project outside of China because it's processing existing stacks from a previous mining operation where the rare earth elements have been activated. So there's no primary mining, no crushing or anything like that. So it keeps the costs down and makes that, I say, very competitive on a global scale. So that's one we were very pleased to get into last year. And one that you may be familiar with again in North America, NextGen. The uranium project up in the Athabasca region of Canada, the Arrow discovery. We have a royalty on the block next door where they've had a lot of successful drilling last year and through this year in Patterson Corridor East. So that's one we're watching very closely, and we're very excited about what NextGen are doing there, which seems to be unlocking an absolutely world-class uranium province. So we're delighted to have some exposure to that. And then finally, I've talked about Kestrel, which is the main one to pick up on here probably. I say this is a mine that's been the bedrock of the company for many, many years. And going back 10, 15 years, it was principally a single asset business. We've seen, we knew production was going to move out of our private lands there. We have a royalty over a certain portion of the mine. Mining activity is moving out of there next year, so that's rolling off. But that's been very significant and very successful royalty for the company. And we've been redeploying that capital over the last 10 years to build the portfolio I've just taken you through to ready ourselves for the day when Kestrel moves on. And to give you a feel for what that looks like, when we bring it all together, these are analyst consensus numbers looking beyond 2024. But if you see that the grey colour there, which is kind of has the checkered box around it, that's the Kestrel income starting to roll off. So in 2024, it was still about 2/3 of our income. In 25, it drops to around 40%. And what you can see, most importantly, I think, in those sort of teal and green units, that's the operations I've talked about, principally, Mimbula, Voisey's Bay, Mantos Blancos, the uranium ones we looked at. That's the rest of our critical minerals, basically, portfolio growing. If you took it back further, in 2020, that was doing about $4.5–5 million. So it's up to about 20 last year. It'll be probably about just under probably 25–30 this year. And as we wind forward with the growth coming through from those assets in the next few years, towards the end of the decade, with the developments come on stream, we'll see that doing probably $100 million. So we see the composition of our income changing very, very significantly from around 41% coal this year to about 2% coal in 2030. And the base metals growing from about 40% this year to probably 85, 90% in 2030. So a real change in the composition of the business and the outlook of the business. And these are all very long dated assets as well then. So it sets the business up very well for the future. But we're in a transition phase as these assets start to grow and come on stream. And you can see some of the current forecast dates on the right-hand side. I can see a question has already come in at the bottom there, so I'll answer that while I'm on this page. Palabora is expected to come on in probably end 27, maybe 28, but the operator certainly targets on in 27. So we haven't pinned down exact dates on those because mines obviously slip a little bit. It can be a bit of slippage around some of those things, but that's fundamentally where we're looking at in terms of the timings. Not included in any of these numbers here is some interesting upside at Mantos Blancos, where they have a phase 2 study going on this year, which will look at expanding some of the existing infrastructure to increase throughput, and that could add a sort of 5,000 to 10,000 tons per annum to the mine. And equally a tailings reprocessing opportunity, which could potentially add another sort of 50% to the annual volumes there. So some really interesting sort of low cost opportunities which Capstone are exploring, and we'll look for more information on those this year. And again, they give some very good disclosures around things in their own results and everything else. You want to explore that a bit further. I've talked about copper. I won't dwell on this too much because we've mentioned some of these, but we think we have the best copper profile in the royalty space. Mantos Blancos and Mimbula being in production, Mimbula phasing up. The Mantos Blancos expansion opportunities I talked about there, Santo Domingo and West Musgrave, and then moving through to things in the next decade as well as Vizcachitas and Canariaco. So we can see kind of a 10-year growth pipeline, and you can see that will take our exposure, if you like, to about £2 million per annum to about £20 million per annum of copper. So real growth there over the next few years, and if copper prices carrying us there we are, that's something we're very, very excited about. As we look forward, what can we expect to see in the portfolio? I'll talk through Voisey's Bay in a little bit more detail in a second, but that's ramping up very much at the moment, and we'll be looking for life of mine expansions. I've touched on Mantos Blancos. Mimbula was an asset, as I say, we acquired a stream over in February of this year. So it was producing 15,000 tons per annum last year. It's looking to take that to 56,000 tons per annum by middle of next year. So we're looking to see that continue to grow, and then they'll probably look for further life of mine extension opportunities. Santo Domingo, I touched on in terms of what they're looking to get done this year in order to drive that FID decision. Palabora, you can see there against the question, the operator's targeting 2027. Piauí is the nickel project in Brazil, where they've got a letter of interest from the USDFC to fund a large part of that. Construction financing later this year, early next year, with first production probably in 2029. We actually have the opportunity to put further capital into that should we choose to. That's at our discretion, and increase our royalty rate from 1.6% to over 4%. And that's a decision we'll take at the point when they're concluding the construction financing. I've touched on Voisey's Bay a couple of times, very briefly. This is a nickel project of Vale's up in Canada. What we can see here in the graph on the left-hand side is some guidance from Vale last year, where you can see that teal section is the underground, and you can see how we're transitioning from the grey of the open pit through into the underground mine over the next few years. We take it's a stream here, so we get physical delivery of cobalt. To give you a feel for the quantums, last year we got around 200 tons of cobalt attributable for Ecora. This year we expect that to grow to 335 to 390 tons, and then when it ramps up fully and gets into steady state, which should be from the end of 2026, you're looking at an annualized rate there of probably about 560 tons of cobalt. The real growth in the amount of cobalt we expect to see over the next few years. And what you can see at the bottom there is the cobalt pricing for anyone who doesn't follow that market closely. The DRC, Democratic Republic of Congo, dominates the cobalt market, and they put export bans in place earlier this year for 4 months. And what we've seen there is the price spike quite aggressively on the back of those export bans. From our perspective, we realized in Q1 just over $13 a pound for our cobalt, and in the volumes we've received so far in Q2, we've been receiving nearer to $19 per pound. So we're already feeling that coming through. So we're blessed here with volume growth and with some price tailwinds as well. And following the ban, the DRC is looking at implementing more permanent export quotas. So we'll keep an eye on how that evolves. But that's a really core part of that near-term growth over the next 2 to 3 years that we talked about. Mimbula, I've mentioned a couple of times. This copper stream, we're delighted to get into earlier this year and acquire this earlier this year. The brownfield expansion I've touched on a couple of times is underway. We won't get a full year here of contribution this year because this transaction only closed out at the end of Q1. But you can expect on a sort of annualized run rate when it's up to full production to be doing around $10 million to us. If you look at the 15,000 tons it did last year, would equate to around $5 million. So, and that's at about $4.20 copper. So copper price is already ahead of that, which gives us a little bit of upside. So we like the structure of that deal. We've actually structured it slightly to accelerate cash flows by having a higher band on the initial phases of production. And then after we get to a certain volume that we've received, it drops down more permanently to a lower level. But we're really pleased the way that's structured, and we think that that's a really, really good transaction for us going forwards. If I look at where we're trading today, you can see here the producing assets are currently, according to analyst numbers, about £1.06p, just over £1, and the current share price is 55p. We've got net debt of about 35-40p to back off from that, but then we've got some real quality development assets, I think, with really good quality operators. And the value of the producing assets today aren't priced in, let alone the value of those developments. So we see it as a really attractive entry point at the moment for Ecora. Our balance sheet, we have a revolving credit facility with the big Canadian banks who are the experts in the space. So Scotia, RBC, and CIBC. Net debt's currently around $126 million. But we're looking to bring that down now. We used our balance sheet to finance the acquisitions, and now we're looking to delever. That's very much a focus for us. And you can see some net debt scenarios there, depending on whether you agree on consensus pricing or want to go 10% plus or minus to those. But we'll be aggressively focusing on deleveraging the business in the next year or two. And then before I move on to questions, basically, that's kind of the very quick overview of Ecora. We think it's a proven royalty model, offering de-risk exposure to a different commodity basket to most of the royalty companies you get exposure to, base metals with copper at the core, some real tailwinds in prices, volume growth coming through for some of those key assets in the short term, and then those developments coming on to really drive future income growth. Balance sheet, we've got a lot of headroom still on our facility, but we're very much focused on deleveraging, and we think it's an attractive entry point with a material discount to the NAV of our producing assets. So that's a bit of a romp through. But with that, I'm happy to take questions. So if anyone's got any, please put them into the box, and there are some in there, so I'll start to take those. First question, can you provide more color around the distribution strategy? Is 20 to 30% payout typical for a royalty company? How's the remaining cash flow deployed? 25 to 35%, I think, is our range that we're looking at. We changed last year. We used to pay a fixed dividend of 8.5 cents per share, but we felt that was more allied with a single asset, highly predictable income generating asset that we had at the time. So we think as we're going into growth mode, we're more of a growth stock. So we've moved to sort of that 25 to 35%. In terms of the payout, the yield is still a pretty attractive yield if you look at it, probably about 5 or 6%. So we think in terms of the dividend yield, that's very attractive for a royalty company and much higher than most royalty companies offer. So we think that whilst we're waiting to grow, there's still a very attractive dividend yield there as we wait for things to come through. Why do you think Ecora is trading at a discount, and what are the catalysts for a re-rating? Yeah, it's a good question. I think there's a couple of factors for that. I think partly you have the issue with the West Musgrave project, as I talked about, being delayed a bit last year. So I think that hit the sentiment a little bit as that was pushed back. And then I think something you may not be as familiar with in the North American markets is we've had some very difficult UK markets have been challenged quite significantly, and the small cap space as a whole has seen a lot of selling, a lot of redemptions. There's been just month after month after month of outflows, and there doesn't seem any sign in the short term there'll be a stop to that. So we've been at the mercy of that a little bit. I think the other thing in terms of our rating, if you look at the cash flow, most of our cash flow is coal, and is relatively short-dated coal. So the quality of those earnings and the multiple they attract is much lower compared to a base metals business, which has 15 to 20 years of income from those assets. So I think as we transition from being income being coal dominated into income that's being base metals dominated. And this year is the first year that's kind of like going to be sort of more income from the critical mineral side than from the coal. So we're at that transition point and inflection point, I think, this year. Then we should hopefully see the business start to re-rate away from that kind of lower quality coal multiple into a higher quality business representing the quality of those earnings. How do the recent global tariffs impact Ecora, positive or negative? I think that things move around so much. I mean, as we speak, possibly the UK and the US are agreeing something. So, as I'm sure we all know, so the tariffs are pretty unpredictable. We haven't seen any real impact on our own business or our own operations or the operations we have exposure to. I think in terms of the commodities, what we're seeing more interestingly is like the Democratic Republic of Congo with the cobalt market. We're seeing similar things in Indonesia, where they're looking to the countries that dominate some of these commodities are looking to put in place policies that actually support the price. And in Indonesia, they've recently increased their royalty on the business they're a bit cash strapped as a nation, so trying to bring some more money into the public purse. And the cost of the mining operations is going up a little bit with more focus on HSE and things like that. So we could see some price support there. So that's what we're seeing really happening and impacting us probably a little bit more than global tariffs. Rare earth is obviously something that's been at the center of dialogue between China and the UK recently. So the Palabora project seems pretty well positioned, given that it's the lowest cost development outside of China, to be one that if anyone's looking to build an independent supply chain, a supply chain that's not exposed to China, that would seem to be very projects very well positioned against that backdrop. Can you update on the status of Ecora's relationship with major shareholder South32? Yeah, South32 became a shareholder in 2022. We bought the West Musgrave and Santo Domingo royalties from South32. And as part of the consideration of that, we gave them equity, which equated to 17% of the business. They've been a shareholder for nearly 3 years now. Their lockup expired 2 years ago, and they're sort of a very supportive shareholder and have been ever since. So there's not too much to add to that, really. How do we source our royalties and look for our royalties? Yeah, I probably haven't got enough time to answer that in totality, but effectively, we do a lot of filtering for projects, look for projects globally that are commodities of choice that match those criteria I talked about earlier: low on the cost curve, high quality ore body, good operator, right geography, and then we effectively find the projects that we think fit those in each of our preferred commodities. We rank them, and then we just get close to the companies. So a couple of the transactions I've talked about today that we've executed on the last 2 to 3 years, we've probably been talking to the mining company that's involved with that for perhaps between 2, 3, 4, 5 years, either educating them on the royalty model or waiting for the right time for both parties. And from that, what I'd say is we're really focused on the commodity price when we enter a project. If we entered something when the price is very, very high and it falls away, then clearly we are going to struggle to recoup our investment, or we'll be dampening and hitting our IRRs. So we're very much focused on investing at a point where that commodity is very much in the kind of, if you look at the previous price cycle, it's very much towards the bottom of that prior price cycle, so that we think there's asymmetric upside risk. And that's something we'll say we're very, very focused on when it comes to deploying capital. And if we look at copper, for example, we did Mantos Blancos in 2019. The copper price was less than $3. When we did the South32 transaction, we priced that at about $3.35 for copper, and it's now obviously well north of $4. So we think we could build a decent track record at picking the right time to invest in these commodities. One more question I'll probably squeeze in quickly before we time out. Do we prefer royalties or streams? We don't mind really. There can be various drivers, and sometimes the counterparty has a preference. But as long as the economics work for us, then we'll look at whatever's the most efficient way for us to make that investment and get hold of that quality, the project if it's a quality project. I've got one more I can probably squeeze in. Is there any chance that the Kestrel will be extended? No, unfortunately, Kestrel, we have a specific private royalty area, so our royalty covers a part of the mine, and effectively we know very well that mining will come out of that area pretty much at some point next year. So the mine will carry on, but mining will be outside of our area, so we won't have any further exposure to that. With that, I think I'm about to come up on time, so I'd say thank you very much to everybody for your time today. It's been a pleasure. Any further questions, please come and ask us. Thank you.